Hey there, I see Thor, you're here. Um, we'll get started at the top of the hour, so in just a few minutes. And if you would for me, hit that little chat button, just let me know that you can hear me okay. Be awesome if you could do that. Awesome. How you doing tonight, Thor? Have you recovered from Cinco de Drinko?
I'm doing great.
Awesome. Well, I'm glad you're here. I appreciate you signing up. I know that's probably a scary thing for a lot of people. You had to put in your email and your phone number and just never know what the heck's going to happen. But I promise you, I'm a real person. I won't, chase you or anything. I'm here to educate you as best I can, give you as much information as you want. Please feel free to, let me know um, if I'm going too fast or too slow, or if there's something that you want more information on, let me know. And I see Christian just joined us as well. Thanks for joining us, Christian. If you wouldn't mind dropping the chat, just let me know that you can hear me okay. And Thor and Christian, where are you guys thinking of buying? What city or town? And what's got you interested in buying a home currently? Just share a little bit.
Sorry, I don't know if were you guys able to hear me earlier?
Yeah, I could hear you. Well, I heard you say something, and I saw your thing there, so I thought, well, hell, I'll just invite you to chat if you'd like.
Yeah,
Um,
I was just saying that I'm working from home right now, so I'm like watching your presentation and working at the same time. But I'm actually just want to see how the market is and just getting some information just in case I might decide to buy within a year or two from now. So it was like I'm not really in the moment to buy a place, but I'm just getting some information and knowledge to help me in the future.
yeah, great. Well, I hope it turns out helpful for you. Like I said, if there's something you want to know, let me know, and you can always reach out to me directly after, and
Sounds
happy to answer any questions.
sounds great. Thank you.
You bet. Hey, Christian and Antoinette, I hope I'm saying your name right. Just if you both would, if you wouldn't mind, drop in the chat that you can hear me okay. And then, yeah, we're at the top of the hour, so I'm going to launch and get going with this little presentation of mine. But please do let me know what it is that you're looking to learn from me tonight, if anything. And maybe you just thank you both for chiming in that you can hear me. So, my goal is to help make you feel more informed and confident and less confused by the time that we're done with this class tonight. Appreciate you showing up and spending this time with me tonight and investing in yourself and your knowledge. And my name's Mark Teran, your mortgage man. Took me years to come up with that rhyme, but people seem to like it. So I'm excited to share some of the best tips and advice that I can give you about buying a home. A quick note on questions before we dive in. If you have a question during the webinar, just drop it in that chat like you did. Let me know that you can hear me. And then if there's something that you want to address, more personal, we can always have a one-on-one conversation after class. Just let me know. I'll send you, something you can book a time with me, and it's free to do that. If you didn't know that, loan officers often work for free and give advice. So we'll stack up the questions as we go along, and I'm going to save up as much time as possible toward the end for Q&A. So you notice I've titled this webinar, Avoid These Costly Mistakes, but it could have another name altogether, which is, hey guys, how do we not screw this up? We're all wired differently, and whenever we're about to spend a lot of money, my first question is, hey, how do people usually mess this up? And so I'm going to show you where buyers trip up so that doesn't have to happen to you. Now, I've packed a lot into this class, So I'm going to move fast, but it's all to make you more confident and prepared. If I'm going too fast or too slow, just drop something in the chat and let me know. Remember, this time is for you. So make it beneficial for you. Just tell me what's going on. I do want this to feel interactive because I don't like to feel like I'm just talking to myself up here. So thank you for saying hello already. And let me know what you'd really like to get out of this class. Also, find that reaction button down at the bottom and hit the thumbs up or thumbs down. Just test it out for me real quick. I'm going to ask you a few questions as we go along, and I want to be able to see when you agree or disagree with something. So can you do that for me? Hit that little reactions button and let me know, where that, yeah, okay. Thanks, Christians. Thanks, Antoinette. I assume you know where it is, Thor. I know you're kind of working at the same time. So here we go. So before we get into numbers and loan stuff, I want to check in with you how you're feeling right now. Just in a word in the chat, just drop a word like how you're feeling right now. It could be anything. Maybe you're excited, curious, have no idea. There's no right or wrong answer. However you're feeling is totally normal. A big part of what we're doing tonight. Overwhelmed. Okay, Antoinette. My goal is to help you not be so overwhelmed by the time we're done tonight. Anything from you, Christian? How are you feeling? And so I want to take you from feeling overwhelmed or confused and at the end, hopefully more clear and a little more in control. And here's something I'm going to share with you. I still remember buying my first house. And when I bought it, I'd already been a mortgage advisor for years. I knew the numbers, I knew the guidelines, everything about it. But when it's your own deal, it's a little more personal. And even for me, it felt stressful, despite all the knowledge that I had. So if you're feeling stressed about, home buying, you're not alone. My goal tonight is to help you feel calmer, clearer, and more confident, at least enough to say, hey, I got this. I know what's going on. I know my numbers, or at least how to get them and what I'd like my next steps to be. A little bit about me. You got my name. I'm working here in the greater Sacramento area. Been doing loans since 1986. I learned this business working side by side with my mom in the San Jose area. And she taught me something that has stuck with me my whole career. And she said, Mark, these are real families and people that you're working with, not file numbers. So take care of them like it's your own deal, like it's your own family. And that's how I work today. I'm honored to have received a 5-star professional award for customer service for every year since 2015. It reflects how my clients feel about the way I take care of them. I'm super proud of that. Today, I focus helping first-time home buyers and move-up buyers here in the greater Sacramento area navigate this process of buying a home, and ideally without feeling lost or pressured. So when I'm walking you through the mistakes to avoid tonight, it's actually coming from a lot of years of seeing what works, what doesn't, and what actually helps people sleep at night once they've gotten into their home. So if you want to do a little homework on me, you can Google Mark Teran, your mortgage man, and you'll find reviews and plenty of stuff on social media. You can check me out. Who I lend through, I'm with American Pacific Mortgage. I've been with them since 2019. They're a national mortgage banker licensed in 49 states, and they're headquartered right here in Roseville. So they're very familiar with the local Sacramento market, which is really cool. They offer a wide range of loan products, which is why I like working for a big mortgage banker like this. They've got the first-time buyer programs, all your standard FHA, VA, and conventional. They've got jumbo renovation, construction, and reverse mortgage loans, HELOCs, second liens, and if we need to for any reason, we also have the ability to broker out. So what that means for you is we have access to a lot of different tools so we can find a structure that fits your situation and your goals. So gives me a lot of flexibility to explore options that may work for you. Okay, a little roadmap, what we're going to cover tonight. We're going to go over the big mistakes home buyers make, how to think about what you can afford comfortably. down payment options and what's realistic in our market, the true cost of buying a home, which is not just down payment, and the right order of steps so you don't feel like you're winging it when you go to buy a home. And finally, what to do next if you want help putting a plan together for your situation. By the end of this, you're going to have a clearer sense of the pitfalls to avoid, how to get the numbers that fit for you, and the next step that makes most sense for your situation. In the big grand picture, the steps to homeownership are pretty simple. You come to a class like this to get informed. You get a pre-approved with a lender. You go house hunting with the real estate agent, and you move into your home. If only it was just that simple. So one thing I want to mention is the big elephant in the room is affordability these days. Prices, rates, and living costs have made buying feel tighter for most folks. Is anybody feeling that way? I know I do, but I want to hear what you feel. So the real question isn't, can we buy? It's what can we afford and when? Anyway, if you're feeling any of this, I want you to know you're not alone. So mistake number one, buyers do the right things, but often in the wrong order. And that's where we get the first mistake. It shows up because they fall in love with the house first and only really dig into the numbers under pressure. But you're not going to do that. That's why you're here. One of the most common ways good buyers end up stressed out is doing that. And this is what it looks like in real life. They start scrolling listings on Zillow or Redfin just to look and see what's out there. Then they'll go out and tour a few open houses. And that's when they tend to fall in love with one. Maybe it's because of the kitchen, the yard, it's just, it fits their fancy. And that's when they'll stop and ask, hey, can we actually afford this? And do we qualify? Does this sound familiar to any of you? I know I've seen it a lot in my career. Okay, appreciate that, Thor and Christian. So the issue with that is at that point, it's not just numbers anymore, all of you, it's emotions. So if you do that, you're trying to make qualification, payment, and down payment decisions while you're under pressure, hoping the math matches the dream of buying a house. That's really the heart of mistake number one. Doing the right things, but in the wrong order. At the bottom is how it would be better done. Start with strategy and conversation. Get a real conditional pre-approval, or what we like to call a platinum approval. Define a payment comfort range for yourselves and translate that into a price range. Then you actually go house hunting. So when you find a home that you love, you can write a confident offer instead of crossing your fingers. It's not about doing more work, it's about doing the same steps in a smarter order so the process feels calmer and more predictable. And by the way, getting a conditional approval or that platinum approval doesn't cost you anything other than time. And yes, I understand time is money, but you put in time, lots of documentation, but there's no charge for it. So it's something that you definitely want to do and not be afraid of. Okay, mistake number two, not checking which programs you might qualify for. A lot of buyers think they have to have 20% down conventional, or they've heard about FHA or a first-time buyer program, but they don't really know what they are or if they qualify. In reality, there are different buckets of loans and programs that can change how much cash you're going to need up front and what your monthly payments look like. Over the next few slides, I'm going to give you the big picture of the main loan types and where down payment assistance and grant programs can come into play. So you're not leaving money or options on the table because you didn't know. Here are the main types of mortgages you're probably going to run into. The high level, most buyers end up in one of a few big buckets. Conventional loans, these are great for buyers with solid credit who have a bit more flexibility on how much they can put down, and conventional loans are often a little bit more flexible with the various property types, especially condos or if you've got a property that might have some repair issues needed. FHA loans, these are often popular with first-time buyers, but you don't have to be a first-time buyer to use it. And in many cases, FHA is more flexible when it comes to credit and income qualifying guidelines. USDA loans, these offer 100% financing in eligible rural areas. Now, most of our area here in Sacramento is not eligible for USDA, but I want you to know that it exists in case your search radius widens. VA loans are for eligible veterans and active duty service members. Most of the time, no down payment required on a VA loan. Anybody here a veteran or military service member? I don't see anybody chiming in. So more loans, there's jumbo loans, and there's which is above the conforming limit, which is, wow, it changes every year, guys. And I want to say it's like 862 this year, but I'd have to look it up. So jumbo, down payment assistance and grant programs, which sometimes will work even for non-first time buyers. There are renovation loans. Some people will buy a home that needs some fix up, and we're able to do that all in one loan at the same time. So that's important. And other non-traditional programs for specific situations. Now, you don't need to become an expert in any of these. That's what you have your loan officers for. The key thing is different loan types can change how much you need to bring in at closing and what your monthly payments look like. So instead of assuming you're just a 30-year fixed conventional, we want to actually look at which bucket makes the most sense for you and your goals. Now, a little bit about first-time buyer and grant programs. These programs change over time, so instead of memorizing them, I want to give you a basic understanding of what they are and how they might help you. Think of them as an extra tool that we can sometimes layer on top of your main loan to help with your down payment or your closing costs. A few things to know. Some are specific to where the home is located. Most of them are income-based. If you make under a certain amount, then you may qualify for it. Some may require you to live in the home for a certain number of years. Some offer more favorable terms or interest rates than the regular market. And a few can even offer very low or zero down when the loan and assistance pieces are combined. The key point isn't, do I qualify for XYZ program? The point is, given where you want to buy in your situation, are there any programs that might help with your down payment or closing costs? I want to show you a few different flavors of first-time buyer and grant programs that might help that are out there. Some are true grants or forgivable assistance that don't have to be repaid if you meet the rules. Some exist to support certain communities or professions, like teachers, police officers, or people buying in a specific target area. Some banks, like Bank of America, offer special programs as part of their Community Reinvestment Act efforts. Some are federal tax credits that can give you a benefit back over time. Most of them are straight down payment assistance that help cover part of what you'd normally need to bring in to close. In some cases, you can combine or stack more than one benefit depending on the rules. Now, this part is really important. Every one of these has its own fine print, rules about income, credit, location, occupancy, and not everyone's going to qualify. So I don't want you thinking that I'm promising you free money tonight. What I want you thinking is, before you assume that you're on your own for everything, let's have Mark or your loan officer check whether there are any first-time buyer or grant options that might benefit you. Now, I appreciate the thumbs up, Christian. Yep. And I was going to say, hey, give me a thumbs up if that sounds good to you. Now, on this slide, you're seeing a tool that I have access to called DPA1. Thanks, Antoinette and Thor, by Freddie Mac. And I'm showing you this because a lot of people ask, well, how do we even find out what down payment assistance or grant programs are out there? This is one of the resources I use behind the scenes. When we're talking one-on-one, I can come in here and plug in things like the city, the county, the zip code that you're looking in, and it will show me a list of down payment assistance and grant programs that may be available in that area. From there, I can click into a program to see the basic eligibility rules, income, purchase price limits, and if there appears to be any funding. Now, a really important point, obviously I've said it before, not every program fits every borrower, but the tool lets me check out what's out there for your search area, which programs we might realistically explore together, and share details with you if there looks like there could be a possible fit. So that's something that I would do with you one-on-one. I'm going to go over here and open it up just so you can see. So I go there, I log in. Okay, housing professional login. I got to give it a password. And so I can put in a purchase price, annual income, credit score, and then I don't know, we'll make something up. We'll say 500,000 on a purchase price. Let's say an annual income of 100,000. Let's say we got a credit score of 650. And then I'm going to type in Sacramento County. And it's going to give me the various programs that we potentially can qualify for here. And I can click on this and it'll give me details about the program, contact the provider, their website. So I can check into things here to see if this is a possible fit for what we're trying to do when we're working on qualifying you. So pretty cool tool. All right, here I want to show you a few of the more flexible and most widely used programs in our area. These are the most popular. I'm not going to go deep into the fine print, but what I want you to take away is there are real programs out there that can help. And when we talk one-on-one, if we do, or whoever you work with as your loan officer, part of their job is to check on which, if any, makes sense for you based on your income, your credit, and where you're buying. Any of these look familiar to you? Like you may have heard the Dream for All or Golden State Finance Authority. CalHAFA, I think, is one of the best down payment assistance programs here in California. All right, so awesome, Christian. So I'm going to zoom back out, talk about down payment options in the big picture. So lots of people still think you can't buy till you have 20% down. I just assume everybody knows that's not the case, but I'm told that some don't. So for most buyers, that's really just not feasible. You wait till you're darn near 50 before you get your 20% down and the home prices keep going up. So you can see two big groups on this slide. First are the low down payment options. These are the kind of options that can help you get into a home sooner without having to wait to have 20%. Then you've got move up and advanced strategies like jumbo financing, the down payment and assistance and grant programs. Buy before you sell strategies are for people that already own a home and they're looking to move up. And the big takeaway from this is that there isn't just one right down payment number. It's really about what you're going to be comfortable bringing in, how much you want to keep in savings, and what fits your long-term plan. My job when I'm working with people is to help you figure out which of these paths you might fit into based on your situation. Now that we've looked at these different options, I want to give you a simple way to decide what's right for you. The right down payment isn't a rule, it's a strategy based on your priorities. So there's three questions for you to think about. One, do you want to keep more cash on hand for like an emergency fund, for moving and furnishing or life flexibility? Or two, do you want a lower monthly payment so you've got more breathing room and long-term comfort? Three, do you want to minimize mortgage insurance? Because A higher down payment can reduce or even eliminate the mortgage insurance, which is going to help out with your monthly payments. There really isn't one best down payment. There's the one that's right for you. So if you wouldn't mind, pop in the chat 1, 2, or 3, which sounds like the best fit for you right now. Now, my job as your loan officer is to help you. Okay. I see a 3 from Christian. I see a 2 from Thor. So that's awesome. Let's see, Christian doesn't want an EMI, and Thor wants a lower monthly payment. Cool. That's what we do. Same with Antoinette. My job is to help you compare your options side by side, so you're not guessing. You can actually see how each choice affects your payment and your cash to close. And just so you know, I work with a lot of buyers, and some are ready to buy in a few weeks, some 6 months to a year to 2 years, and that's fine. And, I'm not here to twist anybody's arm to buy a home. I'm here to help get you educated so you can prepare and buy when it's the right time for you and you can meet these goals. So let's make this, thanks Thor, make this real with an example. Let's say we're looking at a $500,000 home. You can see 3 different down payment strategies for the same house and just changing how much they put down. What I want you to notice, obviously, is the down payment goes up, the monthly payment goes down. At the same time, the cash to get in goes up. And it's not that either one of these are right or wrong. It's choosing the right balance between monthly comfort, what feels realistic to pay every month, and cash on hand, how much you want to keep in savings for life, emergencies, and flexibility. The whole point of this is you don't have to guess. We can put options like this side by side, and you can actually see, hey, if I'm putting X amount down, here's the payment. And if I put more down, here's how that changes both my payments and the cash needed to get in. Now you saw that the payment changes as the down payment changes. On this slide, I want to show you why that happens. If you look at the bars, you can see the payment is broken down into principal and interest, property taxes, insurance, which is homeowners insurance, and mortgage insurance. The key thing to notice is as the down payment goes up, that mortgage insurance goes down. And at 20% down on a conventional loan, the mortgage insurance is not required, so it's gone. A big part of that payment difference isn't just the loan size, it's how much you're paying in mortgage insurance at each level. That is, I'm not saying everybody needs to put 20% down, just means the down payment you choose affects your payment, partly because of the mortgage insurance and partly because of the loan amount. This is just an illustration. For each person that I work with, I create custom tailored options with a full breakdown of all the costs and send it to you as a link with a short video of me walking you through it. And if you're thinking, hey, I'd like to see my numbers side by side like that, even though you're maybe not going to buy for another year or two, that's fine. I've blocked out some time over the next week where we can do a one-on-one consultation and I can create that for you. I'm going to put a little link in the chat. If you're interested, you can book that. Mistake number 3, not getting a conditional loan approval. There are really 3 levels here. First, a pre-qualification. Now, this is the quick version where we talk about your income, your debts, your credit, and your savings, just to give you a rough idea of where you might be right now. And it's great if you're just trying to decide, am I even in the game? Am I even close? A lot of people, they don't know what the numbers look like at 500,000, but they think that's the price range they might be interested in, but they need to see the numbers and get an idea and know, are they close to qualifying or what they need to do. So that's step 1, right? We're just kind of fact finding like you are tonight. Next step is a pre-approval, which is a step up and a more serious version where your loan officer collects documentation. So we get pay stubs and W-2s, We might run your credit if we're all in agreement to do that. And do an automated pre-approval. That's a little more serious version, like, okay, we're kind of nailing it down. And then when you know that you're absolutely like, Mark, I'm ready to buy and I want to nail this down, then the best is a conditional loan approval, which we call a platinum approval. And this is a serious version where we actually get all your documentation, we do run your credit for sure, and we're going to submit your file into underwriting for a conditional loan approval. At APM, we like to do something we call a platinum approval. That way we've got everything vetted out and we guarantee we can get your deal done. Makes a big difference when you go to make offers, because we actually reach out the listing agent to help present your offer. Big part of this market right now, it's super competitive and not everybody gets their offer accepted. You're often in competition with other borrowers. So having a fully approved loan, conditionally approved, is super helpful in getting your offers accepted. The costly mistake is when people stop at just the initial pre-qual and then they go out house shopping. With only a quick pre-qual, there are often surprises hiding in the details. Underwriting is very intense, guys. I've been doing this for darn near 40 years. August of this year will be my 40th year. I work at it 40 to 60 hours a week, every week. And I can tell you that I'm researching and doing homework all the time. And it's just, I don't know, it's a little unfathomable what you learn during the process and what underwriters can come up with. So when we get a true conditional loan approval or a platinum approval, you have a much clearer picture of what you really qualify for, what your payment and cash to close looks like, and how strong your offer is when you write on a home. That's where we're able to reach out to that listing agent and say, hey, I have Christian here or Thor here completely approved all the way through underwriting. This is a solid deal. We're going to get it done. We're going to get it done quick. That's what they want to hear. So if you're just exploring, we can start with a quick pre-qualification. That's just the like, hey, Mark, I don't even know, what the numbers look like at 500, 450, or 600, whatever number it is you're looking at. And I don't even know if I'd be interested, but I want to find out. We do that all day long. When you're serious about buying, then we step it up and do a full conditional approval. So nobody's guessing. All right. When we talk approval, it really comes down to 3 pillars. Every loan program we've talked about is basically asking the same 3 questions. How strong is the credit? Is the income stable and documentable? Usually wanting a 2-year work history. And how much cash available for down payment, closing costs, and reserves? And where's that money coming from? When we do a loan approval, we're looking at all 3 pillars together. If one's weaker, sometimes we can compensate with another that's stronger. If something's off, that's where your loan officer can say, hey, here's what we need to work on so you can qualify for what you want. And this is why documentation matters so much. The rules around income, assets, and paper documentation do not feel intuitive from a borrower's perspective. And in many cases, my perspective or the loan officer either. But they're very real on the underwriting side. And I promise you, the underwriters have the last say. So we want to get that dealt with. One small detail on a bank statement, a pay stub, or a verification can change what underwriting will allow us to use to qualify, or what needs to be explained and documented to be acceptable to underwriting. So a big part of a good loan approval is getting those tricky documentation issues to surface early and out of the way, instead of your real estate agent, your loan officer being blindsided when we're already in escrow and under pressure. I saw that, Thor, thank you. A good conditional approval helps you figure out what price range you really qualify for. It increases your bargaining power. So when your agent sends in that offer with a strong conditional approval behind it, and your loan officer like myself calls them, right? Then the listing agent can tell the seller, hey, this one's been vetted, it's already approved through underwriting. They're much more likely to say, hey, let's accept this offer. It also helps us more accurately estimate your monthly payments and your total cash needed to get in. It helps us narrow down which loan products that are going to fit you the best. So it turns this from, hey, we think we're okay, like a quick pre-qualification, to, hey, we know where we stand and we know what our mortgage options look like. Once you're conditionally approved, the best thing you can do is keep your financial picture as stable and predictable as possible until you close. So we got a whole list of do's here. Do call us if you have any questions. Continue living at your current residence. Keep paying your mortgage or rent on time. Continue to use your credit as normal with no big swings. Keep working at your current employer if you can. Keep your same insurance company. Stay current in all your existing accounts. Expect requests for additional documentation throughout your loan process. Those are all the do's. Don't make any large purchases. Change your bank account or make any large cash deposits without talking to your loan officer first. Don't transfer balances between cards or accounts. Don't close any of your credit card accounts. I see people do that, and it's not a good thing. You can waste away a lot of good history and affect your credit score. Don't consolidate your debt onto one or two credit cards. Yeah, don't do that. Don't apply for new credit or take out a new loan or co-sign on a loan, and don't max out or overcharge on your credit card accounts. These aren't here to scare you. They're here to protect your approval. So if you're ever unsure, just treat it as a rule of thumb. Ask Mark first. Talk to your loan officer. Say, hey, here's what's going on. I need to change my job. Thanks, guys. I appreciate it. Credit, for a lot of people, it's no big deal. For others, it makes them tighten up like just a tight little golf ball. I need you to know I've seen it all, right? If you need help, I'm here for you. Sometimes I'm able to run the credit and run some certain tools and give you a list of things to work on to improve your credit score and your situation. And if for some reason we're needing deeper help, I do have a local credit repair company that I trust that I can refer you to. Now, here's a really important point. Let's talk before you authorize a hard pull on your credit. If your score is already a little marginal, multiple hard pulls, or bad timing can knock your score down a few points, and in some cases, that can change your rate or even your loan options. So most of the times, most lenders can start off with a soft pull and then time the hard pull strategically so it will help you instead of hurt you. Again, always talk with your loan officer. They'll help you out with that. Second big takeaway on your credit, you don't need to be a hero. And what I mean by that is if you see you've got collections, old accounts, or negatives on your credit report, your first instinct might be, I'm going to go pay all this stuff off and clean it up before I talk to Mark or another loan officer. What I really want you to do is pause before you do that. The timing is important here. Sometimes when you're paying off old collections or old negative items, it can actually refreshes the activity date, and that can temporarily drop your score. In other words, your good intentions could backfire on you. So instead of trying to fix everything solo, right, let's make a plan together so your efforts actually help your approval instead of hurting it. And of course, if you'd like to talk one-on-one with me, I'm happy to do that with you. I've helped plenty of people work on their credit and get it to where it needs to be. So I'm here for you guys. Okay, let's talk about where your money can actually come from. On this slide, you're going to see a few common sources that people ask me about. As we go through them, let me know in the chat if you think it's usable or not usable. So 401k and retirement accounts, what do you think? Can you use it or not? Dora says you can use it. Antoinette says no. What does Christian? Christian says no. So it's often usable with rules. Often I see borrowers borrow from or withdraw from their retirement or their 401k. It does have to be documented, and we do need to show where the money actually came from, but it's your asset. And you should be aware there can be tax or penalty considerations, so you might want to go over it with your tax professional. And most people that have a 401k, I'll say, talk with your 401k provider. Most folks can take a loan against that 401k and pay themselves back, so they're not losing any, what do I want to say, traction in the market. And we do that all the time. It's usually like 50%, but you need to check with your provider. All right. What about gifts? What do you guys think? Is that going to be usable or not? Let's see. Well, I see a no, I see a yes, I say a yes. And so, yes, they're often usable for many loan types. Gift funds can come from eligible family members, are perfectly acceptable for down payment and or closing costs. We'll need a gift letter, which your loan officer can send to you to fill out during the process. And we'll need to document the transfer of funds. What do you guys think about stocks, bonds, and cash? Yeah, if it's documented, that's right, Christian. If it's documented properly, we can use it. So stocks, bonds, cash. Yep. Yep. All right, do I have a third yes? Anyway, generally, yes, it's usable if you have money in a checking or savings account or an investment account that you liquidate. It's fine as long as we can document it and source it. So that's good. Credit card. Any thoughts on a credit card? I see a no. Anybody else? I see a yes, no. I see a question mark. So credit card is not acceptable as a source of down payment or closing costs. You can't use a credit card, cash advance, or a personal unsecured loan as your down payment or closing funds for almost every program, as long as I've been in this business. Those are considered borrowed funds and are not acceptable for qualifying. How about a loan? What do you guys think about that? I see a no. Anybody else? I see a maybe. Antoinette, I think you're onto something there. So if it's an unsecured loan, you get the same answer. No, it's not acceptable. If it's secured by something you already own, like we talked about the 401k, that's your asset, you own it, that would be okay. If you owned a property, that would be okay. Maybe even getting a loan against your car because it's your asset, then I'd say yes. What about undocumented cash? So you got cash at home in the coffee jar. I see a no. Anybody else? I see another no. All right. I see a yes. Okay. The answer is no, that's not usable. Cash that's been sitting in a safe, under the mattress, or in a shoebox at home, if we can't document where it came from, we can't use it towards your down payment and closing costs. So the key really is we have to be able to document it. So generally, the lender will ask for your most recent 2 months asset statements to verify your funds. And they're going to flag any unusual or large deposits. Those will need to be paper trailed or we're not able to use them. So in some cases, I have people that have a tough time showing where their money came from or is going to come from. And we wind up like, hey, if you have an established account, so not a brand new account, but your account established, get that money in there. Maybe they're getting money from overseas and it's really hard to track. Get that money in there, let it season for 2 months so that you're going to give me, the lender, 2 months of what I call clean bank statements with no large deposits. So we've seasoned the funds. Then we're going to be okay. If you're ever not sure whether a source of funds is acceptable, ask me before you move the money. That way we can make sure that it's handled properly and it's going to help your approval instead of causing issues. All right. So we've gone over a lot so far. Any questions on anything that we've covered, go ahead and drop them in the chat. And if you'd like to talk, I think I found a way that I can unmute you. So yeah, let me know if you have any questions. And I see Joyce has joined us. Thank you for joining us tonight, Joyce. Not sure exactly when you came in. Okay. All right, I'm going to move on. If you got questions, feel free to drop them in the chat. So here's mistake number 4. Homebuyers often get intimidated by the numbers and costs. And they can't manage their tongue. Okay, so what are closing costs? On this slide, I've broken them into 3 simple buckets, A, B, and C. You don't need to memorize every fee name. You just need to know what type of cost it is. So bucket A, these are transaction and lender fees. These are things like title and escrow fees, lender fees, points, admin fee, underwriting fee, credit report fee. Those all are like lender fees. Rate buy down costs, if you choose to pay points to buy down your interest rate. And any HOA stands for Homeowners Association related or property inspection fees. These are the fees it takes to get the loan and the transaction done, and they're one-time costs, right? You just pay them while you're getting the loan, one time. Bucket B are one-time loan program fees. These are things you'll see like on a VA loan, there's a VA funding fee. On FHA loans, there's an upfront mortgage insurance. These are program-specific costs that are often financed into the loan rather than paid out of pocket. So those are typically financed. And then bucket C are what we call prepaid items. These are things like prepaid property taxes, prepaid homeowners insurance, and prepaid interest, which varies depending on what time of the month you actually close. These are things you'd be paying anyway as a homeowner. You're just prepaying a chunk of them at closing so that your escrow account, also called an impound account, they're the same thing, is funded. All right, on this slide, I'm going to show you a tool that I use with my borrowers. It's called Mortgage Coach to go over their loan options and total cost. So, well, let me click on it so you can see what the heck it is. All right, so you can see here, I've got a picture of me where I can record a video. I'm not going to play it tonight because you got enough of me talking to you, but I'll record a video. I'll have sent you a link that you can click on. You can look at this over and over again. You can share it with friends and family and whoever else might be advising you. I also share it with your real estate agent so that we can all get on the same page. And on here, I can do up to 4 options on one link. So this one, I'm like, hey, here's what 3% down looks like with a DPA. Here's 10% down. Here's 20% down. Here's FHA. I'll highlight things for you. So like, here's our total monthly payment, our total cash to close, down payment and closing costs. And I'll instruct you to click on the more info tab where it will break down your payments, principal and interest, property taxes, etc. And then you can click on the closing costs and we'll click on that fee detail and you can get a detailed estimate of all the closing costs on each of those scenarios. So when I'm doing pre-quals and when I'm doing pre-approvals, I do these up front so that there aren't surprises and we all get on the same page. There's nothing worse than a borrower being undereducated and then, showing up with like, what did you mean I've got to come in with $23,000? I thought it was just my down payment of $15,000. Like, that's no bueno. So I'm here to educate you so you know exactly what's going on and go over your options with you. Appreciate the thumbs up there, Christian. All right. So you're not going to be confused or surprised about closing costs when you're working with me. Moving on. Bad news. Closing costs are expensive. They easily add up to thousands of dollars on top of your down payment. I'm not saying it to scare you. I say it because I want you to go into the situation with your eyes wide open and a realistic plan for your down payment, your closing costs, and reserves. That's money left over. You got to move, and you're probably going to buy new furniture. The good news is you don't always have to pay all of that by yourself. In some situations, it's possible to negotiate and ask the seller to pay some or all of your closing costs. Now, important, this is what they mean when they talk about seller credits or seller paid closing costs. Couple important things. It's gonna, I see the celebrate, yes. So, and this is why your loan officer and your realtor are important as a team, because we need to know these things up front and know what the strategy is that we're going to work on. It's going to depend on the market. If the property is really hot and the market's hot and it's a multiple offer situation, you may not get much help from the seller. In a slower market or in a home that's been sitting, you might have more room to ask. It's also going to depend on the price, the program, and the strategy. Sometimes we might structure the offer a little higher on price. So it's listed at $475,000. We might offer $500,000 and ask the seller to give us a $5,000 credit because we're okay with, it changes our payment by maybe $50, but now we don't have to come in with as much money and it's more doable for our situation. I can't promise that every time the seller is going to say yes, but a big part of the game plan we build together is, given the type of home that you're shopping for and the area you're in, how realistic is it to ask for some help with closing costs? You're not always stuck paying 100% of those costs on your own. Sometimes we use a mix of seller credits, maybe even a lender credit, and your own funds to make the transaction work. And that's what I mean by strategy. Mistake number 5, that's a biggie. Going straight to the listing agent or the builder salesperson on a new home instead of having your own advocate or a realtor. I want to be clear up front, I am not a real estate agent, but I work a lot with a lot of realtors, and I see this play out all the time, and it does hurt my buyers. And here's what I mean. A lot of buyers, they see a house online, they drive by, they see the sign, and they just call the listing agent directly. Maybe they're thinking it's simpler with just one agent, or maybe they think they're going to get a better deal if they go straight to the listing agent, or maybe they don't know any real estate agents, so they just use whoever has their name on the sign. Now, here's the important thing to understand. The listing agent's primary relationship is with the seller. Their job is to get the best result for the person who hired them. That's the seller. Doesn't mean that they're bad or dishonest. I'm not saying that. It just means that they're not there purely as your advocate. That's why in most cases, I really like to see my buyers working with their own realtor, whose job is to protect your interest, help you structure a smart offer, help you navigate your inspections, your repairs, and negotiations with the seller. This applies to new homes as well. That builder sales rep represents the builder and not you. And believe it or not, things don't always go the way they should, even on a new home. So having a professional represent you, in my opinion, is key. You want your own agent who's focused on, thanks guys for the thumbs, your needs, your long-term plan, and helping you make good decisions, not just any decision. The best setup is your lender, hopefully me, and your realtor working as a team together to structure a strong, realistic offer. Your agent is going to be helping you with price, terms, timing, contingencies, and repairs, while your lender is going to be helping you with your numbers, the strength of your approval, and what's realistic and comfortable for you. Together, we're trying to position you to win the house and feel good about your payment and costs. When you choose an agent, A few great questions to ask them are, what's your local experience in my price range? What's their communication style? And how do you advocate for buyers in negotiations? Bluntly, it's a people thing. You're probably going to find there's plenty of realtors. You'll probably find one that you resonate with best, that you communicate well with, and you definitely want one that is a strong negotiator to negotiate on your behalf. Super important. So, as I said, I'm not a realtor. I work with a lot of really good ones in the greater Sacramento area. And if you don't already have someone you love, I would love to introduce you to a few options and let you choose who feels like the best fit for you. And, if you prefer to talk to a realtor first, I'm happy to do that introduction for you. All right. And as I've said before, you can always reach out to me afterwards. You can click the link. I'll throw it in the chat again, just so it's fresh. But you can always get a hold of me. All right, moving on. Mistake number 6. I see buyers tempted by this, especially in a competitive market, and that's skipping a home inspection. And again, that applies to new homes as well. Now, I understand why you might consider it. If a lot of folks have already stretched to get their offer accepted, and possibly someone tells you, hey, if you waive the inspection, your offer is going to look stronger. Or they think the house looks clean and updated, or it's brand new. What could really be wrong? The problem is, from a lender's point of view, I'm focused on your payment, your approval, your cash to close. But as a homeowner, you're going to be taking on everything behind the walls and under the roof. And as silly as it sounds, even on a new home, I had someone who bought one, didn't have it inspected, and found out afterwards they didn't put the insulation in. So when you skip an inspection, you're basically saying, we'll find out about the problems after we own them. Does that sound good to any of you? Yeah, I was looking for a hell no. But anyway, all right. So here's what it can cost you. You purchase a house unaware of deal breakers. That might be foundation issues, roof problems, old electrical, plumbing that's failing behind the walls, things you wouldn't notice on a quick walkthrough. You're losing your negotiating power. With an inspection, you and your realtor can ask for repairs, credits, or even walk away if it's too much. Without it, you have a lot less leverage. You risk inheriting non-structural safety issues like mold, moisture intrusion, or ventilation problems that may not be obvious, but can be expensive to remediate. You miss having a forecast of future repair costs. So a good inspector can flag things like, hey, you've got an aging roof, probably has this much life left, an old HVAC system, or a water heater, so you know that might be coming up in the next few years, instead of you being blindsided and surprised. You're also oblivious to illegal, or non-code additions and remodels. So unpermitted work can impact safety, insurance, and the future resale of your home. You don't want to discover that after you own it. Also, here in California, termites are a big deal. Termite damage is common. You want to know if there's an active problem or past damage that needs to be addressed. So I'm not a home inspector, but I'm a big believer that an inspection is usually, almost always, nearly 100% of the time, money well spent to protect you from surprises later. So if you guys agree that getting a home inspection after hearing this is a good idea, give me a thumbs up. I'll take a heart. Thanks, Christian. Okay, so we talked about mistakes and how to avoid them. I want to walk you through the steps involved in buying a home in about 30 days or less. And FYI, in this market today, usually they want to close in 21 days or less. It moves fast. So I'm going to tell you this story with costs in mind. When we're done with this section, you're going to have a clear picture of who is asking you for money, when those costs usually show up, and a simple list of the main costs that you're going to need to plan for. First things first, how much does it cost to have me and your realtor get you in shape, get you qualified and ready to go to buy a house? Nothing. For the conversation, strategy, and education part, nothing. Our consultations are free. The only possible upfront cost before you're seriously house hunting might be, if we're doing numerous credit reports, we might need you to participate. Or if we know we've got credit problems, we might have a credit report fee. You might need to work with a credit repair service. But you're always going to know what those costs are. They're fairly minimal. So that's it. For all the strategy and help and getting everything dialed in, it doesn't cost you a dime. Your realtor and I do not get paid unless and until we put the keys to your new home in your sweet little hands. It's an ideal setup for you because it makes the three of us extra motivated to get things right. All right, step one, in our 500,000 home example from earlier, the most common number that you would see for what's called an earnest money deposit is around $5,000, 1% of your offer price. This is usually requested by your realtor when you write an offer to purchase a home, and then it's typically due within a couple of days of your offer acceptance. So you put it into the title company. Once your offer gets accepted, things get busy fast. At this first stage, I'm going to ask you for updated documents for your loan file. The title company, who is the third party that helps guarantee that you're getting clear title to the property, and they also coordinate a lot of the paperwork. That title company is going to request some information from you to provide to them. You'll also need to get an insurance quote for the property that you're purchasing. That insurance piece is really important right now because in California, insurance has gotten a lot tougher to obtain in some areas and sometimes more expensive than people expect. So you want to get your insurance quote right in the very beginning. Sometimes I have people, especially if they're buying like up in the foothills where there are high fire areas, they may want to check on what that insurance is going to run them even before they make an offer, because it can be that expensive. Home inspections typically run, well, let me back up. Meanwhile, while this is happening, your realtor is going to be on you about scheduling your inspections so that those happen within your inspection contingency periods. Those inspections, for like a home inspection, that typically runs about $450, and a pest inspection is usually around $150. So for our running total, let's book about $600 on average for your inspections. For an appraisal that you're going to need, and that would be ordered as you get into escrow, that's around $625. So when we add all that together, your earnest money deposit, your inspections, your appraisal, we're about $6,225 so far in our $500,000 home example. Once that inspection is done, you usually have three basic paths your realtor will walk you through depending on your contract and your timelines. One option may be, you guys might say, hey, let's terminate the contract. If the inspection turns up major deal breakers, you and your agent might decide to cancel within your inspection contingency and go look for another home. And of course, you're going to get your earnest money deposit back. In many cases, you're getting your deposit back. It's always based on the contract and the dates which your realtor is going to help you manage. Second option, you might decide to ask the seller to repair 2 or 3 key items. Instead of trying to fix everything, your agent will usually help you pick the most important items for the seller to repair before closing, often with receipts and warranties to be provided. 3, you might negotiate a credit in lieu of repairs. Sometimes it makes more sense to ask for a seller credit instead of repairs, and that credit can reduce your cash needed to close, can help you buy down your interest rate. And the 4th option, if the home comes back spotless, you might just say, hey, we're good to go, and you're happy. So the big picture that I want you to get out of this is the inspection isn't just about finding problems. It's about giving you and your agent leverage and choices before you move forward on a particular home. All right, so in the beginning, I mentioned that the appraisal gets ordered, and once that inspection phase is mostly behind you, it can all of a sudden feel like everything gets quiet. And it's not your cue to go buy a bunch of furniture for your new home or a new car like a Range Rover. And yes, that has happened. Yeah, it's funny, but not so funny. The quiet time is when the appraiser's doing their work and my team and underwriting are working behind the scenes. Your job in this phase is keep your finances boring and stable while we're getting your loan cleared to close and waiting for the appraisal to come in. Once the appraisal does come in and we are approved and ready to go, the lender will send you a closing disclosure that must be acknowledged by you 3 business days prior to signing loan documents. Step 5, that's the fun part. So at this stage, you sign your final loan docs at the title company. You bring in the remainder of your down payment and any closing costs that aren't being covered by the seller or the credits. And note your earnest money deposit that you paid up front, any of your prepaid inspection fees, all of those get applied towards your total funds needed at closing. So it's not extra on top. It's part of what we've already been planning for. Once everything's signed, the docs go back to the lender for review. That usually takes 24 to 36 hours. And once ready, the lender will wire the funds to the title company. The title company will receipt the wire once they've received it from the Fed, and they will release the deed for recording at the county. Usually that happens in the afternoon. And when the transaction records, that's when you get the call that everyone wants to hear. Woohoo! We're on record. This baby is yours. Come and get your keys. Or your realtor comes and delivers them to you. Okay. So my job is to do more than just process your paperwork. 2 big parts of my role. First, I'm going to use my shield to protect you from underwriting surprises. As I've mentioned before, what that means, I'm looking ahead for things that might cause problems with your approval. I'm trying to catch conditions early, and I'm pushing back and clarifying when something doesn't make sense or needs more explanation. Sometimes when I'm advocating for you and fighting to get your documentation accepted within the guidelines, and remember, each underwriter, they're not all the same, and they can interpret guidelines and documentation differently. So in some cases, I may need to push back and or tactfully request management assistance. And honestly, I can get a little beat up in that process. That's okay. I'd rather take those hits on my side than have you blindsided at the last minute. Second, I'm going to be walking you through each step so you're never wondering, and what's going on with my loan. I want you to always know where we are in the process, what we're waiting on, and what I need from you next. So would you agree that if I'm working on your loan, you want me to advocate on your behalf and fight for the best loan terms we can get within the guidelines? That should be a hell yes. Yep. Thanks, Thor. So is everyone going to qualify for the loan amount that they want? The short answer is no. But here's what I want you to know. If I'm working on your loan, I'm going to be upfront and honest about what you qualify for today, I will explore every responsible option to get you as close as possible to your goals without putting you in a risky situation. And if it's not possible right now, give you a clear step-by-step plan so you know what it will take to get there. So even if the answer isn't yes, you can buy your dream house tomorrow, you will not walk away with a mystery. You'll walk away knowing, hey, here's where I stand, here's what I can do now, and here's what it would take to get to where I want to be. On the next slide, I'm going to show you what I sometimes look like after I've worked every angle on a loan file. Let me tell you, on days that I look like this, even my cat hisses at me. But that's the job. You're not supposed to be the one wrestling guidelines, chasing conditions, and going back and forth with underwriting. I'm going to take the bruises. You're going to get the keys. So if you ever wonder, what the heck's Mark doing back there while I'm waiting? Just picture this slide in your mind and know I'm somewhere fighting behind the scenes on your behalf. Your job is to tell us, thanks, man. Your job is to tell us what it is you really want. Be honest with me and your realtor about what you want in a home and neighborhood. Share with us what monthly payment truly feels comfortable. Tell us how much cash you'd like to keep in savings. Let us know your timeline and any non-negotiables. If you can give us that honestly, then our job as your loan warrior and realtor is to take all of that and design a loan strategy that fits your life. You don't have to have it all figured out. You just have to be real with us about what you want and what feels doable. As I mentioned before, I'm not here to harass you. I'm here to educate you. When you're ready, I will reach out. And if you're like, hey, Mark, I'm just want to know where I am right now, and I'm thinking like a year from now, no problem. I appreciate when people communicate back with me, and then that kind of sets us all on the same page. And if you're like, hey, I appreciate you reaching out to me. I've got someone else, family, friend, or whatever it is that I'm going to be using, but thank you for the education. That's cool too. So what I'd like to ask you now is, how are you feeling compared to when we started? Please drop a word in the chat for me. So, did you learn what you wanted to learn? Thor says better, less overwhelmed. Still a little bit overwhelmed, Antoinette? If you don't mind, I'm going to unmute you, Antoinette. And if you have a specific question, anything else I can help out with, let me know.
Okay.
I think I opened it up for you.
Okay, can you hear me?
I can.
Okay, perfect. I feel good. I would say I was sometimes with the home buying, it can be a lot of information. This still was a lot of information, but easy to process. And it was like a step-by-step thorough for each point. So I feel actually I would say confident.
That's awesome. I'll take that as a win. When we're done with this, this is being recorded,
Okay.
so you can rewatch if you want. And obviously, as I said, if you want to call me afterwards or set up a time to talk and go over specific questions, I'm here for you. Like I said, I've been doing this since 1986, and I'll be 62 this year. I am not planning to retire until at least 65, probably not till 67. So I've got another good, 3.5 to 5.5, 6 years for sure that I'm going to be around. And
Wonderful.
happy to help you.
I'm looking forward to it.
Yeah, thanks for sharing. All right. Anybody else want to share or have thoughts? It helps me, to be honest with you. As I mentioned, I'm going to be 62 this year. And so I didn't grow up with social media. I didn't grow up with Zoom or any of this stuff. So this is new for me. This is of doing this class and this presentation, this is only my third one. And, so I want to learn how I can make it better as I go on. And so any thoughts are always appreciated. Okay. Your next steps. If you want to get started or just see where you're at by that pre-qual thing I mentioned, then book a call. There's no pressure or cost for the call. Second, if it makes sense after we talk and you're ready, then we're going to go into a full pre-approval whenever that time is for you. And then once you're there, whether it's with me or another loan officer, that's going to be the time after you've gotten yourself approved. Get yourself approved first. Then it's time to go shopping for your dream home. Once you got your numbers dialed in, and then you want to pick out your realtor, as I discussed. Most loan officers, myself included, we have relationships with who we think are great realtors, and we are more than eager to share those folks with you. A lot of times people have their own people. I mean, let's face it, there are a lot of realtors out there. I know that. But having a good one that you're working with is important. And so that way you can shop with confidence, your price range, your payment range, and the cash to close that fits for you. I recommend talking with a loan advisor 12 months in advance, at least, when you're looking to buy a home. As I mentioned earlier, affordability has been an issue. I can't change it. I don't see a housing crash going to happen. I wish prices would come down, but I don't see it happening for many reasons. We just don't have the inventory that we had many years ago. And so a lot of folks are going to be challenged sometimes with their credit, sometimes with their income and qualifying, and getting with a good loan advisor to know what it is you need to do to get your ducks in a row so that you're ready. I mean, some people, in fact, I had a financial advisor send me a couple not too long ago, within the last month, and they're very on top of their stuff. And so I went over everything with them, and they're not ready right now. And we discussed, hey, here's what you really need to do. You need to pay off these debts. And I was able to explain the process of how best to do that, and kind of came up with a little budget based on their income and their earnings. And here's what you need to have saved so that you'll be ready roughly 1 year to 18 months from now. And they're going to be a much more solid, confident buyer at that time. And fortunately for me, they were open to it, right? Sometimes people want me to just say, you're good to go now. It's not always the best thing for buyers. And so I actually like helping people get it done right. My mom trained me in this business. She was a single parent. We were cash poor. I learned a lot. I'm in a position that most people would envy today because I own homes free and clear. I'm proud of that. Anyway, we're done with the formal part of our class. If you have questions, please drop them in the chat or let me know to unmute you. Oh, thank you I see a great class. I appreciate that. And I will stay on and answer as many questions that I can. And I understand if you prefer to do it privately one-on-one, we can do that. But it does help everyone. If you have questions, promise you, everybody else does too. And so if you're not shy and want to share a question that you have, I'd love to hear it and share my answer with everyone. No, I'll share a few questions that I know people often ask me. They'll often ask, what happens if my home appraisal comes in low? And that's a darn good question. So first thing is often we'll renegotiate with the seller, right? Because the lender's going to base the loan amount on the lesser of the sales price or the appraised value. And so for some people, the appraisal comes in low. They don't have they can pay the difference, but it has to come in cash out of their pocket, or we negotiate with the seller, or maybe we're looking at restructuring the loan for a higher loan amount if we can. Sometimes they'll split the difference, but those are the things that happens when that goes on. Everybody know what points are on a mortgage? Any thoughts or ideas on that? So standard stuff, points, 1 point on a mortgage is 1% of the loan amount. So if you had a $500,000 loan, 1 point would be $5,000. And should you consider buying them? I can tell you most folks, and when I get interest rates, I actually get a whole schedule of like, hey, here's 6% at a cost of, let's say, 1 point. Here's 6 1/4 at a cost of 0.5 point. Here's 5 3/4 at maybe 1.5 points. So I get a whole schedule of rate and fees. And depending on how long you're going to be in the home, how much money you have, and where we're at with payments can make a difference. I often use that mortgage coach tool to give folks their various options to look at what makes the most sense for them. And we do have a little bit more of a conversation in regards to how long they're going to be in the home to find out best strategy on what they might want to do there. Another question, can I lock in my interest rate? And if so, when is the best time to do it? So in most cases, once you're in contract, it's our first opportunity to lock in the interest rate. In varying markets, there's sometimes something called lock and shop, where you can lock in the rate before you've found the home. However, there's often a premium for that. And in most cases, I wouldn't recommend someone do that. So majority of the time, we lock in once we're in contract. We need a lock that's going to cover our contract period because we don't want it to expire. If it expires, we're going to get the worst of what the market was or what it's become. So we want to cover our contract period when we lock in our interest rate. And as a loan officer, as your loan officer, I do have a tool that gives me daily updates on what's happening with the bond market, and I get expert commentary. Bond market has a relationship with what's going on with interest rates and pricing. Most loan officers have access to a tool like that and can give you their educated opinion on, hey, is today a good day to lock, or should I maybe float with the market for a while? You definitely need to lock in by the time you're ready to order your loan docs and wrap up your deal. So that's a more intimate conversation that I have with people during a transaction. Let's see. How do interest rates fluctuate and what factors affect them? Okay, I've been asked that before, and that's a very loaded question. How do interest rates fluctuate? They actually can fluctuate on a daily basis. They're influenced by what's going on with the market, and in different time periods, there are different things happening that have more of an effect. Currently, the current news is there's a lot going on over there with Iran, which is affecting oil prices, and the rise in oil prices is a concern with inflation. And when inflation is concerned, we see pricing on interest rates going up. So today, I actually saw an improvement because we had some improved talks with Iran. But we're in a volatile market right now. It kind of swings like that. It gets worse, it gets better. It gets worse, it gets better. So it's going to vary on what's going on with the market. And we definitely I have conversations with my borrowers. In fact, I have one right now. The market was better like a day or two prior to them getting into contract. And then when they got into contract, the market went south on us and pricing got worse. And we were in a 45-day contract, or 40 days. So we weren't within a 30-day period. And I've got pricing for 45 days. I've got pricing for 30 days. Pricing at 30 days is going to be better. And I said, hey, we've got time on your deal. And I've learned over the years, it swings back and forth. And so when I see it get worse, which means bonds are going up, it's an inverse relationship to interest rates. when the market's getting worse, I've learned that generally it will come back and even out, and then it'll go back this way. So fear and greed are something that happens in our lives. And I learned not to get too fearful. Don't panic. Let it bounce back. We finally got it bounce back today, and the market has improved. And since we still have roughly 30 days on their situation, I recommend giving them a little bit more time and watching the market. So I try and time it and grab it at a good place rather than just panicking. Anyway, hopefully that's helpful to you all. How does my credit score affect my mortgage options? That's a big deal. The better your credit score, I promise you, the better your pricing is going to be. Most first-time buyer programs that people want to use, like CalHFA, if you're doing an FHA, you need a minimum of 640. And if you're doing a conventional CalHFA, you need a minimum score of 680. Now, it's not to say that lower scores can't be done, but I'm going to campaign for you to let's get your credit score improved. The better your score is, the better your terms are going to be. And if you're not in a rush trying to buy something tomorrow, it's important to improve that credit score. How do we do that? One thing you want to do if you have revolving accounts, you want to, I take it as a process. So the first step, if you're almost maxed out, that's awful. It's going to affect your score negatively. You want to be like 50% and less. That's the first rung. And you want to get down to where you're 30% and less of your high credit limit. So let's say your credit limit's $1,000, right? First thing, get it down to your balance is $500 and less. Of course, pay your payments on time. Then get it down to where it's $300 and less. And ideally, you want to be 10% of your high credit limit and less. So 10% would be $100 in this case. And you want to do that with all of your revolving accounts. You don't want to get rid of any of your good accounts, so don't be closing them out. That's why we say not to close them, because part of your score has to do with your history of having good credit. When you close them, it masks it from the credit algorithm. It's a computer that's looking at everything. And if that gets masked, it's not going to help your score. All right. What happens if you change your mind after you've started the buying process? So you've got into contract and, we're starting on your loan, and all of a sudden, oh my God, you've got cold feet and you want out. This is where you're really going to need a good realtor and a good lender working on your behalf. You do have contingency periods. Those are protections for you. You might use one of your contingencies to be able to get out of that contract and not have an issue with the seller. And I can tell you from experience, the sooner you do something like that, if there's not a legitimate reason other than you're just scared as hell, if you do it day one, you're much better off to come out of it unscathed. If you took someone all the way down to you're ready to close and you backed out on that seller, well, they could potentially come after you, or at least your earnest money deposit, if you don't have a legitimate reason for backing out. So hopefully that's helpful. Most of us professionals, in this case, it's about the seller. As a lender, I'm happy to work with you and help you. And if you're not ready, I'm not here to try and twist your arm. Don't ever want to do that. Don't want someone in a house or in a payment that they don't want to be. And most of buyer's agents that would work with you, if you're not ready, just say, hey, I thought I was, been looking at these homes, but this is what's going on with me and I'm not ready yet. I need to put this on hold. That's fine. Happens. Oh, let's see. Any questions anybody can think of? I can go on for days and hours, but I think I've covered quite a bit here. And I could put you to sleep. I think I see a question here. How do first-time buyer programs impact refinancing options later? That's a good question. So depending on the first-time buyer program, like if you were to use the CalHFA, which will give you a deferred second is down payment assistance. So deferred means you don't have to make payments on it, but it is due and payable at the end of 30 years if you sell the property and when you go to the refinance. Now, CalHFA sometimes will subordinate one time on a refinance, but after that, if you want to refinance, you're going to need to pay off that assistance that you got. So that can impact your refinancing there. If you've got a grant that was forgivable, then that's fine. That's some of the GSFA products have that. They often have a first and a second that you're making payments on, and then they also have a forgivable portion. Forgivable portion goes away, but the second on that down payment assistance would need to be paid off when you're refinanced. Let's see. Yeah, there's definitely different first-time buyer programs. Those are the ones that first come to mind. And as I said, when we go over the specific programs that you may be looking at for your situation, then that's a good question to ask me or whoever you're working with as a loan officer. Like, hey, if I'm looking to refinance this, what are the rules on that? And to be truthful, the rules that are today may not be the same rules tomorrow. These things change month by month, year by year, and that's part of being in this business. It's constantly changing and evolving. So it's a great question. All right. Thanks. Thank you for attending, Thor. I hope you got a lot out of this. Have a great meeting. Any other questions? And did I answer your question, Joyce? Hopefully I did. Awesome. All right. Any more questions? Or shall I wish you all a wonderful night? Unless you have another question, I'm going to wrap it up. Thank you so much for being here tonight. I hope you got a lot out of this. Hope you're feeling more informed, more confident. And you can reach me if you have more questions. And if you know of someone that this would be helpful for, family member or friend, please pass it along. You're welcome, Antoinette. Appreciate you being here. So thanks a lot. Have a great night. I'm Mark Teran, your mortgage man.